If you're searching for stocks with the real upside, we're not talking about hype and I'm not talking about clickbait, you're in the right place. I have found 3 stocks that keep popping up on analyst lists and in the headlines as undervalued with massive potential. But the question is that just clickbait? Are they also real? In this video, we're going to break them down together one by one, and I'm going to show you what the numbers say, not the noise. These are stocks that fell hard in 2025 and aren't very popular right now, but that's often where opportunity starts. When prices drop, value investors need to pay attention. A big drop doesn't always mean that a company's bad. Sometimes it just means the market overreacted, because remember, in the short run, stocks are a voting machine. In the long run, they're a weighing machine. So what's unpopular is going to go down. It doesn't mean the fundamentals are going down with it. So here's what we're going to do. We're going to run these 3 companies through our process. We're going to talk about what each business does. We're going to look at the numbers. And then most importantly, we're going to focus on the price we'd be willing to pay by using our stock analyzer tool to make assumptions about the future. And then that tool will tell us, based on these assumptions, this is the price you should pay today. At Everything Money, price versus value is the foundation of everything we do. Finding a great company isn't enough if you pay too much for it. Because our 5th and most important tenet of principle-driven investing is this: a great story becomes a bad investment if you pay the wrong price. The flip side, a bad story can become a great investment if you pay the right price. The example I always give is blue chip stamps. This was one of the best investments that Berkshire Hathaway ever made in the 70s. This was a business that did $120 million in sales when they bought it in the early 70s. 10 years later, it did $100,000 in sales. That's a drop of 99.9%. But you know what Berkshire Hathaway made on that one? They made 15% returns on their money over a 10-year period. Now you might be wondering why. Well, they understood what was underneath the hood and they paid the right price. So now zooming out for a moment, remember, this is a part of a much bigger journey. Each month, we are working together to cross off stocks that are too expensive, and we're going to focus on companies that might be undervalued and worth their hard-earned money. That is why it's so important to be subscribed and to watch all the videos we put out. This isn't about one stock or one video. Over time, you need to learn a process. You need to see real examples, and you need to start to recognize which stocks are getting close to a price that makes sense. This is a journey, and the more consistent you are, the better investor you become, and I can assure you of that. So let's get into it. Now, our first stock is Lululemon, a strong brand that we believe still has a lot of growth ahead as we move into 2026. The company has a clear plan called Power of 3 x 2, which focuses on better products, a stronger customer experience, and growing in new countries around the world. Guys, international growth is a huge opportunity for this company, especially in China, Europe, and new markets where Lululemon plans to open stores for the first time. In the US, it is true, the business has slowed down, but management expects their turnaround plan to really start showing results in 2026, which could help growth pick back up even in the United States. Now let's go analyze Lulu and find the price we'd be willing to pay for the stock. I want to remind everybody, Lulu is a great brand. They make great quality products, and women love spending $150 for their yoga pants or whatever it is. Men even love the store. My stepkids love the store. I like getting things from Lululemon. It is a great brand. We cannot forget that because that's the foundation of finding a great business at a great price. So 1 year, guys, this stock is down 46%. 46%, 1 year. That's a lot. Now, it is a $25 billion market cap. That means if you bought every share outstanding on the market, you'd have to pay $25 billion to own 100% of the shares. If that was possible, I won't get into why it's not possible. But here's what I like a lot. Enterprise value is $27.5 billion. So this difference right here is essentially their debt. So it's about $2.5 billion, okay? Guys, they did $1.13 billion in cash flow last year. So they have about 2 years of cash flow would pay off all their debt. Why is that important? Well, it's important because just like your personal life, if you have way too much debt, it's going to be hard to, if something bad happens. Here, this company has limited debt, and a lot of it's probably stores and things like that. So I like the fact that they don't have to worry about that with their cash flow. And for a dying business, they still had an increase over the last 5 years in their free cash flow. It's currently selling for 22 times free cash flow and 14 times earnings because there is a disconnect between net income and free cash flow. Pretty decent profit margins that are actually getting better. Their 10-year average is 14.45%. 5-year average is 14.9%. Last year, they did 15.7%. So guys, the stock is down from an all-time high of 516 just a little over 2 years ago to a recent low of 159. But these profit margin numbers are getting better. Remember that. Gross profit, 58%. 58%. That means every unit they sell, almost 60% of it goes to the bottom line before taxes and overhead. That's a lot, especially for a retail business. Very little acquisitions, which is good. One thing I love, returns on capital are high. What this means is they're very efficient with their money. They're able to invest their money and get really high rates of return on it. That's how you get companies that can compound and compound and compound. That's really important there. No dividend, which I'm glad. So let's go look at the 8 pillars here. Almost an 8-pillar thriller, but we have that 5-year price to free cash flow is quite different than the 5-year PE. So this is something where I go, okay, I need to understand why is their free cash flow so much different than their net income. Now, I will say it's a lot closer on the 5-year average, but that still is a concern of mine. And you go right here, these 3 pillars, cash flow growth, net income growth, and revenue growth, is purely what did they do 5 years ago? What are they doing today? So their cash flow has grown $708 million in the last 5 years. Their net income has grown $1.18 billion, and the revenue has grown $7 billion. All right, remember I said low debt, buying back some shares. This is pretty good, guys. So let's see what analysts are saying. Now, before I go to the analysts, I want to remind everybody, if this feels overwhelming, you're not alone. It has been overwhelming for everybody in history at some point. The question is, do you tough through it? And I'll tell you right now, it's not that tough. The numbers part you will get. You know, my wife is not numbers driven, but when I talk about things like this, you know, she's been around me enough to hear me and go, yeah, it makes sense. Like, it's not like she's like, what are you talking about? If I say to her, hey, if you have 2 companies and one can invest at 10% a year, the other one can invest at 30% a year, which one deserves a premium? She'll say, well, the one that invests at 30% a year. That's it. None of this is complicated. You can apply everything we talk about here to your own personal life. If you and your friend next door are both investors and one can invest at 15% a year and the other one can invest at 7%, who's going to be worth more over the long haul if they both invest the same amount of money? It's very simple. This is the way I want it to be for you, and it will get there. Now, I had those key metrics up there on the main page. All these metrics right here are super important. So before I go any further, I want you to be able to understand these completely. So I made a really easy cheat sheet, a key metrics PDF that I want you to download. That way you have all this information. What it does is it's going to explain every one of these to you, why they're important, how to calculate it, so you can have it readily available when you listen to other videos of ours, as well as when you look at your own companies. Now, of course, it helps if you have our software so you can get this information right here. So click the link below, download that key metrics PDF, and I assure you, if you're able to understand it, you're going to do very, very well in investing. So back to analyst estimates here. So for this dying company, they do expect decreases in earnings per share right here, but then right back to growth, going from $13 to $20, a 50% increase in the next 4 years. And then revenue. Guys, look at this. 4, 4.5, 6, 8, 6.5. Nothing to write home about. But when you have 60% gross margin, when you're able to add so much profit to the bottom line, you don't need to have 20% growth in order to make good money here. That's what I like about Lululemon. The question I have about Lululemon is, will it be around for the long haul as the brand that everybody has grown to love? That's a very hard thing to do. Is it just a current temporary fad where people just move on from it? These are the things that to ask, because if you price it as a new fad, it's going to be priced a lot lower than if you price it as a long-term Nike. It becomes a new Nike or something like that. Those are the things to consider. So now we have to put the story and the numbers together. And I always go to Stock Analyzer tool very early in my process. Why? Because I want to make sure I'm not wasting my time researching a business that's nowhere close to my price. I'm going to put in very reasonable assumptions, probably follow some analyst estimates, say, okay, if they grew at those levels, isn't anywhere close because the stock's currently at 212. If I do all my numbers and the stock's value to me is 70, why would I do any more research? It's got so much more to go. But if the stock's value is 250 or even 200, okay, let me spend some time on this because it's very close to my number. So let's pull up the last time I've done Lululemon. And we've done it a lot in the last year because it's been very interesting. Guys, I did revenue growth for the next 10 years of 3, 6, and 9%. Now, based on analyst estimates, that might be a little high on the middle and high range. So if you want to alter this, let's go 3, 5, and 7%. Now, profit margin, I did 14.5, 16, and 17.5. I think I remember when I was doing this, I was trying to be a little more optimistic for the video. So let's do 14.5, 15.5, and 16.5. Because as time grows, and by the way, I think at the tail end of 10 years, they could be doing 17, 18% if they keep their margins strong. Then the question becomes, what's the PE and price of free cash flow 10 years from now? Well, they have growing returns on capital. They have high margin. So the question becomes, are they going to be a premier business 10 years from now? I put 16, 19, and 22 because I always tell people to start at 15 or 16, which is the market average, and pay a premium for a great company and pay a discount for a bad company. I would recommend focusing on the ROI, return on capital, and the gross margin here. And then for you guys, I put a 9% return here for the video to see what it's worth. But this is where you put your margin of safety in. Put a much higher desired return for yourself if you don't believe it could be another Nike or another permanent brand. That's how I would do this. So the stock's currently at 212. I hit the analyze button. This is why it's interesting. Low price of 215, high price of 408, middle price of 300. You have to ask yourself, if the middle assumptions occur, is it worth me making 13.5% on my money on this company? Maybe. This is where the margin of safety matters. Some of you might sit there and say, no, it's not enough because I don't know if Lululemon is really structured at that level right now. Our second stock is Enphase, which as of this very second today is up 4.25%. It is a solar energy company that analysts believe could be near the bottom of its cycle in early 2026. Now, the solar industry has been under pressure lately, but many expect it to start recovering, and Enphase could benefit as demand slowly comes back. Enphase plans to roll out new technology like better batteries, upgraded microinverters, and even home backup systems tied to electric vehicles, while also expanding into more countries. Our approach is to stay patient, watch how the recovery and new products play out, and look for an opportunity to buy the stock if it trades at a price that gives us a strong margin of safety relative to value. So let's go see what price we need to buy it at. So guys, just like we did for Lulu, quick recap, is a $4.76 billion market cap business with 5.6 or 6.6 billion enterprise value. That seems a little high because look at this cash flow. Their cash flow is down a lot. 5-year average was 440 million. Last year was 220. So the first question you'd ask yourself is why? Just yesterday, I was on a phone call with actually somebody who used to be a viewer of everything, who actually is a viewer of Every Money, and they happened to reach out to me, and now we've become friends. But either way, he was looking at a business in Dallas to buy. And we called the owner, and the owner was this old curmudgeon-y guy, and he was very angry at the world, but he kept talking about how amazing his business was. So I said to him, hey, can you give me the last 3 or 4 years of revenue? And he starts going through the revenue numbers, and they're declining and declining and declining. And I was like, the first question in my mouth is, why is it declining? You need to see these things and say, why is it declining? That's very, very important. Now, another thing I want to show you that I like, free cash flow is consistently higher than net income. So most people focus on net income. You as an investor is going to sit there and say, but wait a second, let's look at that free cash flow. No dividend, which is great. Decent returns on good returns on capital over the last 5 years. But of course, with free cash flow down so much, return on capital last year is bad. And look at this. Great revenue growth for the last 10 years and 5 years. But look at the 3-year revenue growth, negative 9% per year. Have to be asking those questions. What would make this turn around? So I'm immediately going to go right to the income statement. And okay, so look at this. 316, 624, 774, 1.38, 2.33, 2.29, 1.33, rebounding now at 1.5. So it seems to be on a rebound, but you have to understand why that is. You have to be able to figure out why did it plummet so much. Let's go look at the 8 pillars here. Oh, wow. 8 pillar thriller. 10 times free cash flow, Debt's actually pretty reasonable because we're focused on long-term liabilities, not on anything else. They probably have a lot of current liabilities. Shares outstanding, they bought back some shares, good returns on capital. But again, this is backward looking. You have to focus on what is going from here. What's the reason why this thing is going to continue to increase its revenue from here? So let's see what analysts think about the revenue and earnings per share. Okay, so look at this. Earnings per share, they have dropped this year of 22%, then 18%, 17%, and 15% increases. So going to 345. What's the stock? Oh, wow. So 10 times earnings for 2029. But look at this. This is very choppy. So drop of 14%, 10% increase, drop of 5, increase of 15. So I'm already apprehensive thinking to myself, do I really want to invest in a company where it's so choppy? I can, but I've really got to make conservative assumptions there. So let's go to the stock analyzer tool and let us pull up the last time I did Enphase. When was that? Over a year ago. And boy, back then they were growing like crazy. So do you see how the assumptions on growth have changed so much? Even with analysts, I had 6, 12, and 18% for the next 10 years. Yeah. Let's go 3, 6, and 9. Guys, this is why it's important to remember this. I mean, look at their profit numbers and free cash flow. 10-year average, 22% for free cash flow, 25% in the last 5 years. And look at 1 year, 14%. These things have really changed a lot. This is why it's important to run the stock analyzer and look at your historical stock analyzer to see what has changed in the story since then. Are we in a lull now where I'm being too conservative with 3, 6, and 9%? Remember, the solar panel business is a very competitive business. People are always popping up with this sort of thing. So you got to remember that supply really affects pricing way more than demand. If we flood the market with supply, prices are going to plummet. And it's a lot easier to flood the market with supply than to increase demand. So I'm looking at this going, let's see here. Okay, I'm fine with 10, 15, 20%. And their free cash flow is better. So I'm going to go 13, 18, and 23%. Now, what PE would I put here? Again, 15, 18, 21 is fine, but you need to have a higher margin of safety. I have made every possible investing mistake you can imagine. I bought too high, I sold too early, I listened to the wrong people, and that's exactly why I built Everything Money. It was first built purely for me. I wanted the tools that gave me clarity and decreased the fear of investing. People saw me using these tools on YouTube and said, Paul, can you share those? And at first I said, no, it's a data feed. But then I realized I could make this. So I did. And the real community was born. Real people sharing ideas, live chats, live streams, and tools that help you beat 99% of investors, but most importantly, help you sleep better at night because money can be very scary. I still use these tools every single day, like stock analyzer, real estate calculator. So stop guessing, start learning, start sleeping better. Try it for $7 for 7 days. I'll see you in there. So we hit the analyze button. And we have a low price of 17 to 22, high price of 68 to 78, middle price of 36 to 44. So it seems to be selling for, to me, this tells me, Paul, if you're interested in owning a company like this, go do more research because it's probably selling at an interesting price right now. But guys, as you look at the volatility in this company. Look at the max chart here. This is the max chart. Remember, there were look at this. $324 all-time high, $339 all-time high just 3 years ago. And our community members actually have it as a buy with an average intrinsic value of 43. All right, very interesting to me. This is look at this. This is what happens, guys. Boom, boom. Could this be like Carvana where it falls and then goes right back up again 100x? I don't know if that's going to happen, but let's look at our next company. Another car company. It is called CarMax, a used car company that's going through a tough period as vehicle sales slow down and competition stays high. Right now, the company is lowering prices and margins to stay competitive, which hurts profits in the short run, but could help sales recover over time. CarMax is working to improve its online and in-store experience, which already supports more of its sales, while also cutting costs to strengthen the business. It's also growing its financing arm and expanding stores and reconditioning centers to be ready when the used car market improves. Our plan is to watch how management executes this turnaround and be prepared to invest if the business stabilizes and the stock falls to a price that is seeking below the intrinsic value. That is the key here. Now, CarMax all-time high, $156 per share back in 2021. Why? Because remember back then, you could buy a car, if you bought a car in 19 used, it was probably worth more in 21. That was the booming used car market. Things have changed. Things have slowed down now, obviously. It is look at this, $6.4 billion market cap, $25 billion enterprise value. Its free cash flow is up tremendously, though. Look at this. 5-year average at negative $31 million. 1 year is $2 billion, which is way higher than its 1 year net income of $457 million. Ooh, this one's all over the place because look, 3.3 times sales. Let's go see what the reason for the cash flow increase is. What is going on here? Cash from operations, all-time high. Incredible. That's absolutely incredible. What was the big surge? What was the big surge here? Just all other non-cash items. Change in receivables dropped big time. Change in inventories increased big time. Okay. That doesn't seem like it's a normal stabilized thing. I'm going to focus more on the long-term numbers. And I'm already like, our community members have it as a hold with a $37 intrinsic value. Man, the stock is down a ton from its all-time high. Let's see the 8 pillars. A little choppy. 4 X's, 4 checks. Net income's down. Free cash flow's up. We have a negative free cash from the last 5 years. The data's not there. 10 times 5-year earnings. ROIC is abysmal. Oh, this is awful. Ugh. But Carvana was too. Let's see what analysts think. Wow, look at this. Analysts see surges, 277 to 946, with big growth between 28 and 29. That's far out. Let's see what the revenue. Not much revenue growth, 25.7 billion to 28 billion. Let me go see something that matters to me. What is their gross margin? 11%. So that means every car they sell, they're basically at 11%. Now Carvana, which a lot of people question if their numbers are accurate, are at 21% gross margin. They make almost double what CarMax makes per car. I don't think I've ever done CarMax, is what it says. KMX. Never done it. So, guys, I'm going to pop my cherry right in front of you guys. That's usually some sort of OnlyFans premium. So, let's sit here and make assumptions about CarMax for the future. I'm going to assume they're pretty stable on revenue. So I'm going to do 2, 3, and 4% revenue growth. Now profit margin. It's declined. I would say 2, 3, and 4% as well. And I'm going to make the cash flow the exact same thing. Now PE. Guys, low returns on capital, very tough business, not very good gross margins. I want a discount of this thing. I want 12, 14, and 16 times earnings and free cash flow. And finally, based on these assumptions above, what is the company worth intrinsically based on a 9% return? I hit the analyze button. Oh, shit. What the hell happened here? Tim's happy. 45 on the low side, 122 on the high side, 79 in the middle. So even making pretty conservative assumptions, I have some pretty good upside potential here. The question is it a good enough company? Guys, I was surprised by this. I thought I was going to see a lot of red here. Shows you how numbers and story might be wrong. So guys, especially in this video on CarMax, comment below if I'm missing something, because obviously I've done zero research on CarMax. I have no idea, but I don't like the metrics of the business, but I like this a lot. So tell me some comments there. And if you want to see the companies that do fit my process that I think I look at and go, these are obvious, I picked 7 stocks that I believe will beat the actual Magnificent 7 over the next 5 or 10 years. And I'm going to be honest, this past year's results were not what I expected. So you're going to want to see who made the list. So click the video on your screen right now. Thank you for your time.